think what keeps me up at night is the fact that only 2% of venture capital globally goes to women founders. The World Economic Forum has said that it would take 152 years to close the gender gap. I don't think any woman on this stage wants to wait 152 years for gender parity. So that for me is a challenge that I think we need to keep paying attention to.
The portfolio should be divided in 4 parts. One should be cash-rich portfolio. One part should be capital, working capital, and some part in fixed asset, 25% in fixed asset, and 25% in products, goods.
For me, it's very important. I always see it. When somebody comes and see me, a potential investee company, I don't sell them something that's on the shelf. I look at the situation and I'm able to do a tailor-made instrument.
We have to adapt to change, and with that, we've now allocated, I would say, good 30 to 40% has now been allocated to the asset diversification of this whole AI. The AI is the new buzzword, and there's so many unicorns we're starting to see emerge more and more.
Since we don't manage third-party capital, we can afford to have a, if you wish, no rules, because as a CEO, obviously, we try to minimize our risk, or at least to, to invest in a risk-reward, where we have a risk-reward adjusted returns higher than probably the funds or the private equity guys.
So I want to introduce this panel, and like I said, it's a nice group, very diversified in terms of geography, in terms of what they do, and I guess this is probably one of the reasons why you're here, is to kind of understand what the long-term investment cycle, investment strategies you all want to pursue, and the things that you're really thinking about. So with me now on this panel, we have Sandro Salzano, who's president of the Salzano Family Office in Panama. We have Sana Kapadia, Director of Strategy, 2x Global UAE. We have Deepika Patel, the Chairwoman of the Patel Family Office in the United States. And we have Marlene Ngoyi, the CEO Fund for the Export Development in Africa. And we have Ashish Vijayan, who is the chairman of VJ Global. So let's start. I don't want to take up too much of your time. So let's start now, and then we will look into kind of the longer term horizon. I wanted to quickly kind of ask the panel in terms of, we're obviously seeing now there are so many changes that are happening on both the macro and on the political side. And it's impacting the way that we think about investment, the way we think about trade, and it obviously gives us a lens of what we really need to think about in the future. So I wanted, just as a start, to ask you all, what are you most concerned about in 2024? So we've got the Gaza war and the Red Sea attacks, which have obviously disrupted trade. It's obviously playing into things like inflation. It's impacting a lot of industries. And then we have, global interest rates and the expectations that interest rates are going to go down. We have also the US elections coming up. And in the background, we are obviously seeing a prolonged issue in terms of US and China tensions. So I just thought, maybe let's ask the panel, what are their thoughts and what are they really thinking about today? So maybe we start with Sandro.
Yeah, I don't think we are concerned, because those are, obviously we have US elections. It's going to be perhaps the main event this year. I mean, we have other elections. Even in Panama, we're going to have elections, but I guess it's not going to be as important as the US ones on the global landscape. I believe that Gaza or Qatar is working on a solution, so probably on the macro side, it's probably it's not going to disappear, but I would say of all the events you mentioned, probably I'm more concerned of a black swan scenario. So something that actually, the economists or global bankers are not predicting. And that's how we look at things, because obviously you have always a consensus, right? And so, I mean, interest rates, they are, there is Goldman who's saying that they're going to start in maybe in June, and Bank of America is going to say in April, and then there's going to be 4 cuts, and somebody is going to say it's 3. So obviously, we are not that good at making predictions, so we leave that to other people. But we always look at, in terms of asset allocation, in terms of the way we manage our portfolio and we manage risks. I think we always like to look at worst case scenarios and also at events that are not necessarily in the list you mentioned. And that's probably what the way we hedge, for example, in certain countries, in certain economies, in emerging markets. But I would say, the list, probably US, I would say, is probably the in my view, the main event this year.
Okay. Sana, do you have what are your thoughts on that?
Yeah, thank you so much. And I mean, in our context, in the work that we do, which is around mobilizing capital with a gender lens, I think what keeps me up at night is the fact that only 2% of venture capital globally goes to women founders. The World Economic Forum has said that it would take 152 years to close the gender gap. Climate change, we all know, disproportionately impacts women and girls. And if we keep going down these trajectories where women are underfunded, over-mentored, and don't get the right catalytic funding that they need to grow their businesses, to build their funds, etc., I fear that funding gap will keep getting worse. From a more traditional mindset, there tends to be a flight to safety when things are a little bit more difficult in a challenging investment environment. And with funds that we talk to, for example, there's the sense that they're having more conversations where investors are activated around a gender lens, but when it actually comes to writing the check, that isn't flowing. And I think that we're at a time, where that just needs to change. So that's definitely one big challenge that we keep brushing up against. And then I think it's also the investor types and who's willing to provide that risk capital that's actually needed. So some of the institutional investors that we work with, their ticket sizes are too big, or they have certain perceptions about risk. And actually, for me, this forum where there are family offices and foundations where there's the ability to provide some more catalytic capital, I think there's an opportunity to really bridge some of that gap. But yes, I don't think any woman on this stage wants to wait 152 years for gender parity. So that for me is a challenge that I think we need to keep paying attention to. And I'll pause there.
Deepika, what are your thoughts on that?
Yeah, no, I mean, I think I totally agree there. We're a women-owned and women-managed family office. And predominantly we're seeing, more and more founders, lack of capital there. And so from our perspective, we're very strong on trying to find those women leaderships and trying to empower them, trying to provide them that foundation, the platform, the technology, and the financial structures in order for them to evolve and grow. So there's more women on the men's table. But from a risk perspective, we're a US-based third-generation family, and so after the pandemic, we've really started to focus on some of the global geographical asset allocations. And so with that, obviously the interest rates that continually rising in the US has caused some huge effects on us as a real estate and hospitality firm. And so just continuing to try and diversify those allocations into new geographical locations like here in the Middle East, particularly Dubai, Saudi Arabia, Morocco, Egypt, and just, continuing to network and grow and just really trying to learn from each other.
Ashish?
During this time of 2024, when there's a lot of turmoil in the market and a lot of uncertainty in the financial market, money market, I recommend people to invest more in goods and business which can't be affected by inflation, because there is a lot of things that we can't control. What we can see is how we should invest. and where we should invest. So non-inflation, anti-inflation goods, anti-inflation business, investing in the developing economies with higher returns and risk management. I think these few points will be very nice for the business.
Is there any kind of economic, social things that worry you?
So there are a lot of social and economic things that are happening around the world. Geopolitics is a very important factors which changes the way technical data is being seen. So there's a lot of technical data, but when geopolitics enters, it changes everything. So I think we must focus on our risk appetite and the policies of a country which is looking forward for long-time goals, achieving long-time targets, and not see short-time targets, short profits. We should go for long-term things.
And you know what? You stole my thoughts, because I was going to say, so I'm the CEO of a private equity. We manage about $1 billion that we invest in Africa. And I always say the one thing that you can be certain of is that there's going to be issue during your holding horizon. So in the case of private equity, it's 10 years. So our strategy from the onset have to be built in order to resist anything that could happen. So you're talking about interest rate, you're talking about war, you're talking about election cycles. In 10 years, you're always going to be facing something. And Deepika said it best, the way we want to address it, at least that's what we do at FEDA, is through diversification. Diversifications in terms of the countries, the sectors, the instruments that we use, the just diversification, and also just going back to the fundamentals, making sure that you invest in assets that have sufficient cash flows to survive when there's a down market. So we saw a lot of people being too bullish and they've collapsed just because the markets weren't there anymore. So we try to be conservative, and to me that's the way to address it, but that will never change.
Marlene, you bring an excellent point. And now the question is, so how do we structure our portfolios? Because, you know, we're seeing a lot of changes in terms of the investment market, right? I mean, what used to be mainstream is now no longer mainstream. What is traditional is kind of also changing. So I wanted to ask you, how do you structure your portfolio for the long term? How much of that is traditional versus modern? I mean, I know we have an excellent panel of just family offices, which gives you kind of that nimbleness and agility in a way that a lot of traditional funds and institutional investors might not have, right? Sandro, I just wanted to get your thoughts on that.
Well, you know, we always been, I'll say, overweighting alternative. So our specialty, I think, has been always private equity and venture capital. Emerging markets, obviously, the bias has been Latin America for us. So everything from Panama, where we own one of the largest free trade zones, all the way to Argentina. So we are very long-term investors. So my wife always said that I think like a 90 years old guy, because I usually take, you know, a 20 plus years view, and nowadays everybody obviously is very short term, and everybody wants to make money fast and get out fast. For us, it's always been, you know, trying to understand really. It doesn't matter if it's the sector, but really the fundamentals. Really trying to find ways to protect our capital, so a cushion. And this strategy worked for us, but I guess so we don't have a magic formula. But in terms of allocation, I don't think it will change much for us, because I mean we like and we think we understand Latin America. So obviously we'll stick to that in terms of geography, in terms of asset classes. We have, it's pretty balanced in our portfolio. So we have the private equity, venture capital, real estate, and it's probably a third each. The venture capital started small and then it became very large. We just got lucky last 15 years, I think, like many, investing in the Sequoia of this world or something of the Airbnb, Uber of this world, and then a lot in LATAM. So I think that, you know, we don't really look at the at the top-down perspective. So because we really look at the bottom-up individual companies, and so we'll stick to what we think we understand. So the allocation will be balanced between, we always try to keep some cash, but I would say very, very overweighting alternative investments.
Sana, what do you think?
Yeah, I mean, I appreciate Sandra's point about the long-term view. And as an example, if I think about how gender lens is being applied in a public markets context, a few years ago, the Japanese pension fund put 2.9 billion into a equity-based index, and then topped that up with another 2 billion 2 years later, with the underlying statement that as investors and as stewards of money, if we're not thinking about the social aspects, we're exposing our portfolios to a whole range of risks. So that's one way that we're seeing a social lens get more deeply applied. And then another example is of an endowment that I'm an advisor to, and there's 3 components to that endowment. One is a very small allocation that's for public markets, for that liquidity that's required. But then the big crux of what this endowment does is invest in first-time and diverse fund managers at the intersection of gender and climate finance that really brings then that E and the S and the G together. And then another small portion that's grants, and that then provides some catalytic capital that's needed at an early stage for research and other things. And we have tons of other examples like that of really creative, multi-asset class, impact-focused, but also commercial. I think that's a key message, that it's not just about a social return, but also a commercial return, and this increasing recognition that gender is material for an investment strategy, and there's different approaches to construct that in your portfolio.
Deepika.
Yeah, I mean, I think I couldn't concur with the both of you. We have always been a pretty short-term player in commercial real estate, and obviously the pandemic has taught us a lot, and so we look at more of this longevity now. We look more long-term, we look at a more 10-year outlook, and how we're doing that is our asset allocation is now more geographically globally focused. And given that, these new markets, emerging markets, we're very focused now in BRICS. We're looking at a lot of new investment opportunities in Brazil, Russia, India, China. Obviously, real estate has been our core competencies, so we've now launched a new alternative investment desk that's predominantly focused in this blockchain AI space. So that kind of helps us balance our cash flows and liquidity and come up with a new strategy and approach to more of a longer-term investment outlook.
Okay, and Ashish, your thoughts?
So I believe in diversification of the portfolio, but I think it depends on the size and the strategy of the company or a fund or a country. And I think the portfolio should be divided in 4 parts.
Four parts.
Four parts. One should be cash-rich portfolio. One part should be capital, working capital, and some part in fixed asset, 25% in fixed asset, and 25% in products, goods. So like we can take it into stock markets or any other, but it is actually a very ancient Indian philosophy that the portfolio should be divided into 4 parts. So it keeps the business running. You always have cash, you have working capital, you have fixed assets. So it will make a balanced combination for success.
So if I was going to ask you, which asset do you expect to outperform in 2024? Fixed income, equities, or real estate? What's your guess?
You said all the 3.
You think all 3 will outperform?
Oh, yeah, all 3 will outperform. Of course, you have to choose the location for your real estate. Suppose Dubai is booming. I mean, Dubai, if you would have bought a property or asset in 2020, and today it has outperformed 3 times more. So real estate is very good. So I think equally dividing your risk is a very good policy.
Marlene, I have a question for you. So now, I mean, we're looking at this and we're obviously talking about much longer term horizons, and you work for a private equity, and your term in terms of investment horizon is probably one of the longest, right? Because with a lot of these funds, you're talking about a long-term equity holding of 5 to 7 years. And then also, sometimes your companies can see all kinds of economic shocks. The stock market could be tanking. It could be a hard time for whatever reason, and it impacts your ability to exit. So my question to you is, how do you navigate between those cycles to make sure that you guys are on steady ground?
Thank you very much. That's a very good question. And that's oftentimes when I talk about private equity in Africa, and I encourage people in this room to consider that asset class, to consider Africa as a place to go. We've had the highest growth rate in the world for the past decade, quite frankly. And when you know the continent, you know how to navigate the risk or the perceived risk. But how do we do it? For me, it's very important. I always see it. When somebody comes and see me, a potential investee company, I don't sell them something that's on the shelf. I look at the situation and I'm able to do a tailor-made instrument. So for instance, if I'm in a situation where I'm dealing with a very attractive investment in an industry that I like, with the type of cash flow profile that I like, a return profile that I like, I may structure a self-liquidating instrument. So when we say private equity, it doesn't have to only be equity. I could be in a situation where I say, you need time to grow. I don't want you to go to the bank and have to repay principal and interest every quarter. You need patient capital. I can give it to you, but that can be a mezzanine. I can give you 8 years to develop your growth plan, and you repay me in a balloon repayment at an acceptable return. So we do a lot of that. Oftentimes, you could have a situation where somebody needed you for more than the cash. You help them at the board level. You help them with key relationships. And they're in a position to buy you out at the end. That's something that can be agreed in advance. So we tend to be very pragmatic about those things at FEDA and structure things in a way that we're able to give a liquidity and a return to our investors. I'm very glad to say we started investing in 2021, December, and already this year, the anchor LP will receive a check based on these type of instruments that we've put in place that work very well for the business and for ourselves.
Sandro, what are your thoughts? How do you structure your portfolio? And it looks like you're kind of more on the traditional camp rather than, on the newer camp, like Deepika, who's getting into blockchain and all the new asset classes of the future. Sandro, how do you structure your portfolio to make sure that it lasts 5, 10, 15, and 20 years from now?
So the way we structure portfolio is pretty simple. We look really at, as I said, 20 plus year. So when we buy a company, we try to hold it as much as we can, unless there is some fundamental change. So we have a listed part that is actually, managed by our team, and also we have external managers. But I would say where we really focus our attention on is really the companies where we buy majority or minority stakes. So it's a lot on the private equity side. So we're now looking, for example, at Mexico, Brazil, Colombia, Panama. And so for us, it's really the way we structure it is so it's long-term, geographic, is EM, LATAM, and I would say we haven't been active, for example, last 2-3 years because we thought valuations were very high, and now we are. I think it's a good moment to start again, especially on the venture capital side. So we definitely are. We're not very. We don't have to exit a position like a fund. We don't have the FOMO, so we need to get into a new industry because everybody's getting into it. Actually, when something like that happens, it's probably not a good sign for us.
Yeah.
So as a family office, obviously, we can be very flexible. We don't need to have a rule per se. I would say that we've been compounding 30% IRR last 15 years, so we did pretty well without taking any leverage. And again, since we don't manage third-party capital, we can afford to to have a, if you wish, no rules, because as a CEO, obviously, we try to minimize our risk, or at least to, to invest in a risk-reward, where we have a risk-reward adjusted returns higher than probably the funds or the private equity guys. But we don't have, we don't need to have a, we don't have LPs, so we don't have to, have the structure you probably have in a private equity fund or an hedge fund.
So I think also one of the questions that are kind of on people's minds is how do you structure your portfolio to make sure that you have your right exposure in terms of geography, and the global economy is becoming more and more difficult because we're seeing kind of a step back from globalization. We're seeing increased protectionism, and obviously this is kind of playing out in terms of the investment and trade flows. So my question, because now we have a really great panel of people from all regions, how are you seeing this, and are you finding it that it's more difficult today to invest in developed markets, your traditional like the US and Europe, versus, for example, Africa and Asia?
Yeah, so I can take that question. So, I mean, I think, being a predominant US-based focus for 3 decades now, it's been difficult for us. We spent the last few years really investing in the research and development, trying to understand these emerging markets. And really, ultimately, what it comes down to is trying to align our interests with other strategical partners at local ground. We're a strong hospitality firm in the US, but we may not be that in a different country. So trying to find those partners and that have that strategic alignment and understand the risk mitigations and have the same visions as us has been challenging. And so with that, huge investment we have done in research and in development in these African markets, because that's what we want to do, is trying to geographically align our asset allocation and our asset portfolios. And so, from that given said, looking for those markets like Africa or the UAE markets and understanding and trying to find those local people who have that SME and have those knowledges so we can align and strategically grow together.
Ashish, it looks like you're kind of pivoting towards Asia.
No, I have been working in different parts of the world, and I'm very keen on developing my business in Africa. For 75 years, we are working in diamond and gemstones, and Africa being one of the most prominent source. So, but what I have felt is the success in these developing countries is very much depending on the transparency. If you bring transparency and trust in your business, suppose in Africa, in India, and you're more transparent and clear for the people, for the investors, I think there is a huge scope, and you choose your partner rightly who have the same vision of being transparent and being trustable. So I think success has no end in the developing countries.
Marlene.
Can I please?
Yeah.
So I do think that historically investors have been a little bit lazy because we could find returns in comfortable markets that we understood nobody is ever going to get fired in the US for making an investment in Silicon Valley, etc. Going to the likes of Africa is more difficult, but quite frankly today, and I'm a little bit biased, I'll admit, but when you think about the key challenges and opportunities of this world, you have the climate. Africa is at the center of that question. You know that to have electric vehicles batteries, 80% of the raw material is in Africa. Talking about coltan, cobalt, that's one thing. When you think about, again, climate, you think about the forest. You have the Amazon, you have Borneo. The second largest in the world, if not the first, is in the Congo Basin. Africa matters when it comes to that. You look at the potential of solar and hydro. After China, the next 100 gigawatt capacity is Inga in the DRC. When you look at now the demographics, that's important as well. In 20 years, Africa will be 2 billion people. Half of these people are below 18 years old. Those are your future producers. Those are your future consumers. You cannot ignore it. Last but not least, something that is very strategic. We often talk about oil and gas and raw material, but what is more strategic than your food? We know that Asia is going to run out of arable land because of the demographics in India and China. We know that South America will feed the US. Europe will be self-sustainable, but Africa is key. We have some of the countries with the most arable land available. So I do think that at some point investors need to not be lazy, because while before they could get away with it because the key was always Africa is risky, they can no longer. I look at investors in the US, I'm like, if you can invest in crypto, you can certainly invest in green energy in Africa and things like that. So I do think that we're going to start seeing people being forced to get out of their comfort zone and seek that diversification that is key to sustainable returns and relevance.
You bring an excellent point. And so now we're talking about all these new markets and opportunities, but sometimes they're not as straightforward. So a couple of years ago, everybody was all gung-ho on China. Now it looks like India has overtaken China in terms of interest, in terms of expectations of growth. So, and everyone, you can see a lot of investors starting to build up, their positions in Asia and specifically in China to capture some of that growth. But we saw recently with the bankruptcy of Evergrande, it's not super straightforward. So how do you make sure you are making the right decisions and exposed in the market and in the investments that you really want to be in?
So this is what back to what we were saying before. I don't think that you need to be trend seekers. When you start jumping from one place to the next, looking at the next best trend, you can do that maybe if you are very short-term oriented. I think that when you're long-term oriented, you will try to find the champion wherever they are. So I'm sure there are still some champions in China, there are still some champions in India, there are some in Vietnam, there are some in Africa. That is more the approach that I have, to say there are good companies everywhere. Like I said, I still very much believe in Silicon Valley when it comes to technology and AI, and I think it'll never change. So I don't think that we should say it's one or the other. I think it's all of them finding the champions in the right geographies, backing the right strategies, being if possibly, in industries that have a future long term. That would be my view.
So I'm going to ask you now another question. So we obviously know that, in terms of investments today, there are all these new opportunities. We're seeing, in the past, it used to be that your mainstream was your real estate. Even cash wasn't really considered like an investment asset class as it is today, when you could put it in the bank and make some money off of it. So, you have your alternatives, which were always considered private equity, private credit, infrastructure. What are some of the new alternatives, the new assets of the future that you guys are seeing? Sandro.
More than obviously, we have I would say, a very small bucket where we take obviously probably excessive risk, which I don't recommend. But for example, and in this case has been for us investing obviously new technologies. We've been for example investing in AI. We started probably 5 years ago, so we have a portfolio of 20 companies. We are obviously, you can have exposure through some of the Magnificent Seven, so probably Google, etc. But we do position in Anthropic. We have a position in OpenAI. We have a position in with Elon now with the X.AI. So obviously, I think that, and talking to guys like Yuri Milner or Eric Schmidt, they are friends. They obviously they would tell me that obviously you won't have exposure to that, and it's going to transform many industries, and will definitely have more productivity. As a matter of fact, I think tonight we are announcing an MOU of one of our portfolio company signing with a leading AI company. So I would say obviously I don't know which one is going to win. You know, it's a race, and obviously there are dangers. But it's something we are, you know, where we've been investing for the last 5 years, and now I see some hype. So obviously valuations are not necessarily low, and probably for many, still the best bets are in the listed the companies. Some of the, at least Eric was telling me that you know, the best talent is in you know, in the Alphabet, Apple, Amazon of this world, right? So it's very difficult, I think, for some startups to compete. But having said that, some of those startups will probably either go bust or they'll be acquired by some of the large players, right? So we're probably going to have a, you know, 1000x, or probably apart from OpenAI, where I think we have a cap on the upside. The rest, you know, I mean, the upside can be pretty substantial. So I think that there will be something we are keen on, and I'm not sure if you consider that an asset class, but yeah, definitely as a sector, it's something we build exposure over the last 5 years.
Sana, what are your thoughts on that?
Again, coming back to the context that I work in, I'm going to, for investing in, for example, gender diverse funds, there is IFC research from 2019 that shows there can be a 20% outperformance in your IRR by having that kind of diversity in your portfolio. The other untapped opportunity, I think, and possibly relevant for this space, is the power of women's wealth and the immense intergenerational wealth transfer that's happening as we speak. I think the last estimate suggested that women are accumulating wealth. I'm going to look at my notes here. It says 5 trillion being added globally by women. And in the Middle East in particular, there's about 768 billion untapped power of women's wealth. What might it mean to serve that in a way through better financial products, to actually align with women's more values-based approach, a life cycle approach that they take to investing. So there's a lot of untapped opportunity that we see in that regards too. And just to come back to the point about emerging markets, I think what we're seeing in our work is that there's so much leapfrogging happening when it comes to solutions. The entrepreneurs on the ground, whether they're in Africa, in India, in Latin America, they're coming up with solutions that are much more contextualized, they're capital efficient, and they're high growth businesses. So there's a big evolving, growing market out there that investors can be tapping into as well.
Deepika, in the US, I mean, I just want to ask you, because you're from the US perspective, what's your views around NFTs, crypto, blockchain, investing in wine?
So I'm pretty old school, you know.
Okay.
I was raised by my grandfather and father, and so we've always been predominantly in this real estate and the commercial world. And when I got married, you know, I married an entrepreneur who would talk about this Bitcoins, and he'd have these apps on his phones, and I didn't even know what crypto meant. But when I saw his bank balance going up more than mine, obviously I started to adapt and learn really quick. So, you know, there's this whole persona on this crypto space, and they're avoidable scams. And then you're seeing a lot more and more wealth generation, especially with that next generation. And so with that, me as, you know, the chairwoman, and I'm really trying to encourage my staff in the investment strategies also to, we have to adapt to change. And with that, we've now allocated, I would say, good 30 to 40% has now been allocated to the asset diversification of this whole AI. The AI is the new buzzword, and there's so many unicorns we're starting to see emerge more and more than just the chat GPTs of the world. Later today, there'll be a great showcase of a new AI launch as part of one of our portfolio companies. And I look back at the journey and think, you know, it's so great now to be global and think about all these new technical changes. And so I think it is really important, as any asset portfolio allocators do, we have to learn from each other. We have to learn from the subject matter experts in the technology reams, and learn to adapt to change real quick, or we're going to be left behind in the times.
Ashish, in terms of technology and looking at these new asset classes, I mean, it's very apparent. Not only is it obviously kind of helping us in terms of our development, et cetera, but it's also opening up a lot of new opportunities around social impact, around philanthropy, empowering people that would have probably not been able to get these opportunities in some emerging markets where, you know, the government can't just pick up the slack on behalf of the private sector. So I wanted to kind of get your thoughts on that.
So I think the new AI technology and the way the technology is developing in combination with the tradition, which are like thousands of years, which has proved themselves as an asset class, and improving on them through the new technology will make wonderful results. So suppose the way the things are made, the art, the jewelry, the diamonds, exploring, there's so many things which are changing. They're traditional, but now the way of seeing them, analyzing them through the new technology, those kind of products which are based on AI technologies and tradition are going to do very well. And I think in all the asset classes, we must see the value. Rather than products which are marketed more, we should think about the value, because that value will remain for a very long time. But the products which are marketed today and the marketing goes down after certain number of years, the value will change. So I recommend people more to put their investments in products which has value based.
Marlene, what are some of the opportunities you're seeing, and what would you want to kind of share with this audience as well when we're looking at new technologies, and obviously kind of your presence, you have that perception, you're on the ground in Africa as well, like you're seeing it firsthand. What can you share with the audience?
I think it's what Deepika mentioned. It's the opportunity to leapfrog. This is what I call, sometimes you have a first mover disadvantage.
Yeah.
Sometimes when you're last and you don't have anything, you get to do it later, but better. So I'll give you an example. I grew up in Europe, as you can hear from the accent. And I remember that mobile banking in Europe was just additional service. But you would still have your brick and mortars, agencies, and all of the cost that goes with it. And when you go to Africa, particularly, you must have heard about the company M-Pesa that really revolutionized mobile payment to the point that now fintechs in Africa is pretty much the old-fashioned banks. Even old-fashioned banks have to wonder, should we be opening bricks and mortars agencies all over the country? Is that the most efficient way to do it? Should we not just be closer to the fintech and have more mobile solutions that are more convenient to customers, that is, that has less buying power, that doesn't want to be spending time in traffic or spending that transport money? So what I love really is technology in Africa is not just gimmicky and like an additional comfort. It can really disrupt entire industries. I hope that we're going to see it applied to education, to medical services, to a lot of different things. And the advantage is that we have a blank page, so we can do that without mudballing huge investments made in the past. So that's an advantage. I think it's very important, and I'm very excited about AI. I think that that's going to revolutionize productivity for white-collar worker already. I use it 50 times a day. I can't function without it. Soon it will come to blue-collar worker as well with robotics. I think it's one of the most extraordinary things that I've seen in my lifetime in terms of progress we'll make.
Well, thank you. Thanks for listening to this panel, and thank you all for, an engaging conversation.
Thank you so much. Thank you.